Hey, this is Arthur Hill, Chief Technical Strategist here at TrendInvestorPro.com. Thanks very much for tuning into our YouTube channel. If you like this video, please give us a thumbs up and consider subscribing. So today we're going to talk about the 200-day moving average and the S&P 500 or SPY. In fact, we're going to put the 200-day to the test. So first we'll look at overall performance over the last 20 years, and we do have a lost decade at the beginning. Then we'll look at the 200-day and how it's performed over that 20-year period, and then compare some different 200-day SMA crosses with 200-day EMA crosses and see how they stack up. So over the weekend on Arch Charts, I put out an article entitled Knowing When to Add Risk and When to Reduce Risk. And I was basing this on a simple moving average crossover. And what I want to do today is I want to show you the charts that I used and then show you the back test and show you how a little smoothing can go a long way and how using a broad market timing mechanism can also help you identify periods when the broader market trend is up, maybe when you want to add risk, and when the broader market trend is down, perhaps when you want to reduce risk. So I decided to run a back test using the 200-day moving average, and I decided to go back to 2000, and I really like starting in 2000 because that's when a bear market started. And why would you want to start during a bear market? Well, that's because your starting date really can influence your results. And when I do a back test, if possible, I want to see at least two market cycles. And a cycle would be up and down, down and up. And to get at least two cycles, you need to go back to 2000 to get an idea of how things might have really performed. Because if you perform a test that started in 2009, of course, it's going to look great. Everything's going to look great since 2009. But if you look at this chart here, you can see that clearly there was a lost decade there from 2000 until 2010 when the S&P 500 SPDR here pretty much went nowhere. Now, even though over this period, if you go back since 2000 and you can see that we have a annual return of 5.8% and a total return of 226%, you can see that getting there was not exactly a straight path. And this is the argument for market timing, because you can see in order to get to that 226% gain and that 5.8% annual return, you would have had to endure a 48% drawdown, a 56% drawdown, and then the most recent, a 36% drawdown. And then you got some smaller pullbacks or consolidations along the way. So I think the question we have to ask ourselves is how can we get this buy and hold return without the drawdowns or with limited drawdowns? You can't eliminate drawdowns, but you can reduce them with a little bit of market timing. So this chart here shows the 5-day SMA in green in the top window and the 200-day SMA in red. And then in the lower window, we've got the closing price and the 200-day SMA. And the point here is that with a little smoothing, you can cut out a lot of the whipsaws or false signals. If you look here in June, we had a dip below the 200-day, but the 5-day SMA did not dip below the 200-day. Here in March, we moved below, the 5-day moved below the 200-day, but didn't get back above on that little bounce. Whereas here you had 1, 2, 3, 4, 5 crosses basically of the 200-day. So a lot of whipsaws there. So that simple smoothing mechanism can help you reduce the whipsaws and the bad signals. Now let's put these to the test. So now I'm going to jump over to EMA Broker, and I've got SPY, dividends included, and I ran a back test where you buy on a cross above the 200-day, you sell on a cross below the 200-day SMA, and there we can see down below the compound annual return, comes in at 4.86%, and you had a maximum drawdown of 24%, 22 winners, and 52 losers. So you only had a 30% win rate. And if we look at that on the price chart, I've shown the signals here, and there you can see those whipsaws that you're going to get here that we had in February and March, and we just got a cross now. That hasn't whipsawed. It is still a valid signal. But we can go back through the chart, and you can see here in October, November, we had some whipsaws as well. This oscillator below just shows the difference between the 1-day and the 200-day SMA. So we can see a lot of signals coming out. But what happens if we just use a 5-day SMA? Will it affect the returns? And again, I'll show these results in a table when I'm done showing these charts. But we can see with the 5-day SMA, we get the return up 5.76%. We get the drawdown lower, 21%. That's good. And you can see the winners, 13, and the losers, 19. So our win percent got just above 40%. So clearly that 5-day SMA smoothing is helping. And then if we look at the actual signals, and I'll go ahead and I'll change this to a 5-day. So this is a custom indicator that I've created, but it might be available on stock charts someday. But if you look here, you can see that instead of getting the whipsaws there, we got a little bit later of a signal with the move below with the 5-day SMA moving below the 200-day in early March, and we've got a bullish cross happening here in late May. And if we go back and we look at that period, October and November, we still got some whipsaws, but fewer whipsaws than if you'd just been using the closing prices there. There you can see down, up, down, up, down. And then we didn't get a whipsaw here. We had a clean cross, whereas the SMA had a couple of whipsaws there in early February. But most importantly, you can see that the returns improved, the drawdown improved, and the higher win percent. So this makes the 5-day SMA cross better than the 200, than just a close above and below the 200-day. So I also tested the 20-day SMA crossing above and below the 200-day, as well as the 50-day, 200-day cross. And I'll share those results and then look at the table here. But this is the 20-day SMA crossing above and below the 200-day. And right away, you can see fewer signals, far fewer signals than the previous two. Your compound annual return got above 6%. So you had a higher return, but that was at the expense of a higher drawdown, up to 29%. You had more winners than losers. So, a little bit more in compound annual return, a higher win rate, but at the expense of the drawdowns. And then if we look at the 50-day crossing above the 200-day for signals, you can see fewer signals, even fewer signals. Your return stayed above 6%. Your drawdown went up, though. You had 7 winners and 3 losers. So let's put this all together on a table to see how it looks. So here are the performance results all laid out on a nice table. And you can find this table in that article I showed you at the beginning. You just go to the main articles page and ARTS charts to find that article. What we can see here is there's a compound annual return. So buy and hold, you got 5.8%. And you can see if you just use the 200-day, your return went down significantly. And if you just added that 5-day SMA, you got your return close to the buy and hold return. And then you got a little bit more return, but not that much with the 20-day and the 50-day. Now, what's interesting here is look at the drawdowns. All right, we start with that 55% drawdown with buy and hold. That was in 2008. And then you can see just a moving average added gives you a 24% drawdown. And then you get to 21% with that 5-day. And then the drawdown starts getting higher again. So that's kind of like a sweet spot for the drawdown. And I think with the market kind of where it's at right now, I'd be more interested in the lower drawdowns than anything else. So as I said, the win percent does increase as you extend the moving average period from 5 to 20 to 50. And you can also see that the average gain, of course, increases. But what's interesting is if you look at the profit factor, and Google that if you need to know what the profit factor is, but it's basically the total amount that you made from the winners divided by the total amount that you lost from the losers. And you want a profit factor above 2. Now, there's not that many trades in this test, but you can see the profit factor is pretty stable once you hit that 5-day SMA cross. It stays well above 4.5. And that is positive, I think, for the profit factor. In other words, you're making more money on your winners than you're losing on your losers when you total them all up. And finally, the exposure is another thing to consider. So even though you're getting a return that's pretty much equal to buy and hold, you can see with buy and hold, you're exposed 100% of the time. And if you use that 5-day, 200-day cross, you're exposed just 71% of the time to the market. That means the other 29% you can do something else. Look for an alternative to equities possibly. So just a little note on what we're doing recently here at trendinvestorpro.com. This is the article as well. It's on Trend Investor Pro or on Stock Charts. And I've got a 4-part series running on the Stoke Close strategy, backtesting an ETF portfolio. Part 3 is up now. Part 4 will be up soon. And I also tested the breadth thrust. And that article can be found a little bit lower down. But we had the percentage of stocks above the 50-day SMA surging above 90%. And that was a breadth thrust. And so I took those indicators to the test to see how they performed over time and built a model in EMA Broker. And there you can see all the signals. And then I quantified it with a table showing how these signals worked out over time. So I also tested the EMA crosses as well just to see how they compared. And a couple items to note. So here are the SMA returns, and we go from 4.86 to 6.01. And there you can see the EMA returns go from 4.94%, just higher, but then lower than the comparable SMA returns that we saw just above there. The drawdowns are pretty similar, maybe a little bit better for the EMAs. The win percents are pretty similar. There you can see going from 30 to 70% and 29 to 71%. This 20-day EMA seems to perform differently than the 20-day SMA. You can see a big difference in the win percent there. And then a couple of other things that I was noticing here is with the profit factor. All right, you can see with the 5-day SMA and 20 and 50-day, you got a profit factor above 4.5, a nice strong profit factor. But you can see with the EMAs, with the 5-day EMA, 200-day EMA cross, you had a low profit factor of 2.73. And you also had a lot more trades. You had 15 winners and 23 losses versus 13 winners and 19 losses. So that might have resulted in the lower profit factor. Profit factor went up with the 20-day EMA and 50-day EMA. But overall, I'm still going to go with the 5-day, 20-day SMA cross for my signals. So if you'd like to know more about trendinvestorpro.com and some of our other strategies and backtest, please visit the website, very modest subscription price. Also, if you like this video, please give us a thumbs up or consider subscribing. Thanks very much for tuning in and have a great day.